In this video, we're going to discuss the difference between a periodic and a perpetual inventory system. So with a periodic system, we're updating inventory at the end of each period. So when I say period, I'm talking about the end of a quarter, at the end of the year. We decide, okay, we're going to go and do a physical count of the inventory, and then we're going to update what's happened to the inventory asset account. With a perpetual system, we're continuously updating the inventory account each time we buy or sell inventory. So let's walk through an example. Let's say that we have in our beginning inventory 50 units that came at a cost of $5 a unit. So under both the periodic and the perpetual system, we'd have the same amount of inventory. We'd have $250 would be our beginning inventory. I'll just abbreviate BI. So BI is going to equal 250 for both periodic and the perpetual system. But now let's say that we made a purchase. Let's say that we bought 800 additional units of inventory, and they came at a cost also of $5 a unit. So now we have to say, okay, what journal entry do we make to reflect this? Well, under the periodic system, what we're going to do is we're going to debit something called the purchases account. So we're going to debit purchases for $4,000. And how did I get 4,000? I just took the 800 times $5 a unit. So that's 4,000. And then let's say that we made these purchases with cash. So we credit cash for $4,000, but it just as easily could have been accounts payable if we didn't pay cash. So now with the perpetual system, remember we're continuously updating the inventory account. So what we're going to do is we're going to debit inventory directly. We're going to say a debit to inventory of $4,000, and then we're going to credit the cash for $4,000. Now you might be wondering, well, what happens to this purchases account? How is this different from inventory? Well, that's something we're going to talk about as we get toward the end of the video, so just hang in there. So now, let's say that we sell 750 units of inventory at a price of $12 a unit. So now we need to know how to record this sale. Well, part of this is similar. So let's say that we sold it on credit. So we debit our account receivable for $9,000 and credit sales for $9,000. Where did I get the $9,000 from? Well, I just took 750 units and I multiplied it by our sales price of $12. Now for perpetual, we also are going to debit accounts receivable for $9,000 and credit sales for $9,000. Now it looks like, hey, you account for a sale exactly the same way under periodic as you do for perpetual, but we're not finished yet because there's one other component to this. Think about it. We've actually got rid of some inventory, right? We sold 750 units, so we have to account for that. We're going to reduce our inventory account. So under the perpetual method, we're going to say a debit to cost of goods sold and a credit to inventory. How much? Well, we got rid of 750 units that we had on the books at $5 a unit. So 750 times 5 is $3,750. So we're going to credit our inventory for $3,750. Remember, we said that we're continuously updating the inventory account with the perpetual method, whereas the periodic method, we're not going to make an entry here. So I'm just going to put no entry to record the inventory because we're going to deal with that at the end of the year, the end of the quarter, what have you. So now let's say that we do get to the end of the period. Let's say we're at the end of the year. And so now we're saying, okay, look, let's do a count and see what's in our ending inventory. And it shows we have $500 in ending inventory. Now with the perpetual method, we don't have to make a journal entry. Now there's no entry required. Why is that? Because we've been updating the inventory account. Look, remember when we bought the inventory and put it on the books for $4,000? We debited inventory. And when we sold the inventory, we credited it. So we don't need an entry because we've already been doing adjustments to inventory as we bought and sold inventory. But with the periodic method, we haven't been doing that. What did we do? Well, we had this purchases account over here, and then over here we didn't even have an entry. So first off, we're going to need to zero out this purchases account because that's just a temporary account. It's not a real or permanent account. There's not a place for it on the balance sheet or anything like that. So what we're going to do is we're going to credit purchases for $4,000. Why are we crediting it? Well, before we debited it for $4,000, to make it go to zero, that means we would just credit it. Okay? Now, in terms of the debit, what we're going to debit cost of goods sold, and then we're going to have a debit to inventory. How do I know this? Well, let me just put in the numbers here for you. There's going to be a $3,750 for cost of goods sold and $250 for inventory. But more importantly, let me show you how we got these numbers. So let's look at this cost of goods sold number. So what we do is, to get that cost of goods sold, we can set up a formula. So we say we had $250 that we started with in terms of inventory. That was our beginning inventory. And then we added $4,000 worth of inventory, right? We added that. That was our purchase. And then we subtract whatever our cost of goods sold is, and then that must equal our ending inventory, which the count shows was $500, right? So by using this ending inventory amount, we can solve for what our cost of goods sold was, right? All we're saying here is really simple. We're just saying, look, what we started with, if we added something to it, we took something away, and that left us with $500. And our only unknown is what we took away, what the cost of goods sold was. So now, if we add cost of goods, if we look at this equation here and just do a little algebra, if we add cost of goods sold to each side, then we'll get cost of goods sold over here, and then we subtract this 500 from that side, we'll end up with $3,750 equal to our cost of goods sold. And then that's what we do. We just plug in a debit to cost of goods sold of $3,750. Now this $250 in inventory, that $250 right there, that's just our plug. We knew the purchases was a credit of $4,000. We knew the cost of goods sold, we debited for $3,750. So to make the entry balance, we needed a debit to inventory of $250. Now, although there is no entry required when we think about the perpetual method, we can also just go and say, okay, does the ending inventory actually add up to 500? So let's look at this. So we got our ending inventory is going to be equal to 250, which is our beginning inventory, plus what we bought, what we added, our purchases of 4,000, and then minus what we sold. Well, we sold 3,750, right? There's our cost of goods sold right there. So all we do is just do a little math here, and we see that our ending inventory is $500. Ending inventory equals $500, and that's what we have here. Our count shows that we have $500 in ending inventory.